There's a seminal study conducted at Trinity University into retirement planning. This is where the 4% rule, or the rule of 25, came from. It basically says that your portfolio value should be equal to 25 times your living expenses in retirement. So, for instance, if you have a living expenses of $40,000, your portfolio value should be $1 million. And this portfolio will last you into your retirement by up to 30 years after you retire at the age of 65. This is simple enough. But what's interesting is the caveat that this research came with. The researchers noted that there was certain success rate or failure rate, and the success rate depended on the withdrawal rates, your allocation, and returns. There were subsequent updates to the study, and they noted that the failure rate ranged from 0% to 6% for the 50+ allocation to stocks. It is difficult to tell what the failure rate will be. It all depends on the future returns. But if you fail, you will reduce your portfolio to 0 before you reach your 30th anniversary in your retirement. In this video, I will cover all you need to know about different strategies that you can use to maximize your success rate. First, what determines whether you succeed or fail is the sheer lack of timing. Retiring into a bull market will boost your performance of your portfolio for years to come. But retiring into a bear market is the worst thing that can happen to any of us. Retiring into a downturn will force you to sell securities at a rock bottom prices. This will prevent you from taking advantage of a future recovery that will follow. Here are the steps that you can take to shield yourself from this trouble. The first thing is to determine the time it takes for markets to recover. Luckily, you don't have to peruse through price charts. Morningstar did this work for you in their 2023 article. There, they looked at the length of average time to recovery since 1990. The time to recovery is when an index reaches its break-even after a period of decline. This means that the index must have topped its previous peak. The values they came up vary depending on the category. For instance, large blend category, where S&P 500 is, the average time to recovery was half a year based on 49 cycles. The large growth category had average recovery of 7 months, with a max recovery of 13 years. They are referring to the dot-com bust here. Morningstar also showed other index categories such as bonds and international equity allocations. I linked this article here. We see that the intermediate core bond category recovered in 6 months with max recovery of 2 years. There is a word of caution here though. Morningstar based their time estimates on nominal returns unadjusted for inflation. Thus, the recovery times can be longer depending on inflation rates. So in summary, we have about half a year for a full recovery for both bonds and equities. But it could be much longer. Most of these recovery cycles happened outside of recessions. So if we look at the previous recessionary market cycles, the recovery time can be 2, 3, or 5 years. Of course, the recovery from the Great Depression was the worst of 25 years. I'm not sure if we will ever see things turn out that bad, but no one knows. With that in mind, you can set your own estimated time for recovery from the dips. Half a year is probably too aggressive, but maybe 5 years is too conservative. Let's assume 4 years for the sake of this example and roll with it. And the next thing that you need to determine is how much you will be spending in retirement per year in your living expenses. And to determine that, you need to sit down and estimate it. Take a good inventory of your preferences, and preferably you should have tracked your living expenses for the past 1 at least or 2 years. And that will allow you to actually tell with a certainty how much you spend per year. Having some sort of budget tracker would help. I made a video where I show how to use Google Sheets as a free budget app on your phone or your desktop to keep track of your expenses. Let's say your living expenses are $40,000 and your cash cushion will be $160,000 or $40,000 times 4 years. So what do you do with that money? Preferably, you should put it in a high-yield savings account where the risk of any loss is almost zero. And it's not an ideal situation to put in a savings account because money tends to rot in savings accounts due to very low interest rate that is much lower than the rate of inflation. But at least savings accounts are FDIC insured up to $250,000 per person. Another option is to invest in short-term treasury bills. And the best fund that you can invest is by Vanguard Short-Term Treasury ETF, or VGSH. VGSH will have a slightly or perhaps better rates or yields compared to your savings account. But as you can see from the graph, VGSH is not immune to price declines. And then this is especially true if a Federal Reserve starts to raise interest rates. In this case, VGSH will lose its value. It will lose due to price depreciation. So depending on your risk preferences, one or the other can be a better match for you. But overall, you will have that $160,000 as a cash cushion to rely on in case you retire into bear markets. And you will have that sum of money to live through and wait out until markets start to recover. This will prevent you from selling securities at rock bottom prices and take advantage of that recovery later. The next thing let's look at is there anything we can do to lower that cash cushion requirement of $160,000? I mean, after all, it's a quite large amount of money for just cash to sit and rot in your bank account. And in fact, there are actually a few things that you can do. First, consider the dividends and interest that you receive from your portfolio. Let's say that your portfolio consists of 60% of S&P 500 and 40% of Intermediate Treasury Bond Fund, VGIT. S&P 500 pays about 2% in yield, while VGIT has a yield of about 3%. Of course, these numbers will vary from year to year, but let's assume that this is what you will get in your first 4 years. If your portfolio value is 1 million, this produces 12,000 in dividends and 12,000 in interest income, or 24,000 in total. What you can do is to subtract 24,000 from your annual living expenses. Why? Because this is the annual investment income you will get to cover your living expenses. Thus, you will need to set aside only 16,000 times 4, or $64,000. That's a big reduction from $160,000 to $64,000. Oh, you may say, maybe I should switch all of my portfolio or make a higher concentration into dividend stocks and bonds. But be very careful here, because dividend stocks and bonds, they tend to exhibit lower performance returns in the long term compared to, let's say, Nasdaq 100 or S&P 500, which should be the core holdings of your stock allocation. To juice up your portfolio even more, you can invest in REITs, or real estate investment trust. One example is the Realty Income, a popular one, with a ticker symbol of O. The Realty Income has the yield of 5.8%. Just only be careful that REITs distributions or dividends, they are taxed as an ordinary income typically. And so depending on your tax bracket, you will be responsible for paying somewhat higher taxes for federal or state compared to, let's say, qualified dividends. So there are some trade-offs there. A more extreme method to increase your portfolio yields is to invest in preferred shares ETFs. For instance, one example is the iShares Preferred and Income ETF, or PFF. The preferred shares ETFs that have slightly higher expense ratio. So for instance, PFF has a expense ratio of 0.46%, and the yield though is quite high, that stands at 7.4%. Just be aware that preferred shares ETFs are not riskless, and they have quite long maturity profile, and this makes them quite risky, and their price can decline in case Federal Reserve starts to raise interest rates. So let's say that you swap 10% of your S&P 500 holdings for PFF. This produces the following dividend income and the required cash cushion result. As you see, this is almost $18,000 less than our initial estimate. So we will be able to reduce our cash cushion amount from $160,000 to $42,400. As I said, a large allocation to dividend earning assets such as preferred ETFs or bonds or dividend stocks should be a temporary phenomenon only for the first 4 or 5 years of your retirement. That's where the most of the risk of failure happens when you retire into bear markets. Another thing that you can do to minimize your risk of failure and have the lower cash cushion requirement is to have some sort of passive income streams in your retirement. This could come from your maybe other investments, or maybe you wrote books, or anything that actually earns you money without your active participation. So you can subtract all that passive income from your cash cushion requirement for the year. And alternatively, of course, you can continue working. Many retirees still retire and continue working for their companies, like some sort of side hustle or the consulting. And this will also lower your cash cushion requirements. And of course, on a very extreme scale of things is to lower temporarily your living expenses to avoid selling into bear markets. Of course, this is not ideal and this is a very extreme, but still it's an option. With that is it for this video. I hope you learned something new today and you got something out of it. Please give it a like and subscribe to my channel for more content about personal finance and investing. Thank you for watching.